thank you for joining us.
Thank you.
I trust it's not too hairy outside in terms of protesters.
Not this hour.
Not at this hour.
Yeah, not sure about later.
No, okay. Well, we'll have drinks by the pool for a couple of hours. You can hunker down there with us when it all calms down. Yes, I'm looking forward to it. Yes. Fantastic. So we're just going to start off talking a bit about how the REIT markets are performing, looking at some of the implications from a geopolitical perspective. Then we're going to look at some of the strategies being employed and some of the key themes coming there, where the opportunities to be found, have a look at the mainland, and also look at some of the changing trends that we are seeing in this landscape. First question to start us off, I'll direct this towards Daniel. How is the REIT market performing today? What is the general outlook?
Well, thank you very much, Michael, for having me this afternoon, and as well, thank you very much for my two colleagues on the panel here. Accessibility to management is one of the key for us on the buy side, and the more access we have, the better we can do our underwriting, and hopefully the better is our performance at the end of the year. And touching on that point in regard of your question, Michael, it's a phenomenal year for REITs globally. We are up 20% on the global FTSE Nareit EPRA index, 22 to be very precise. This is kind of a special situation, as I guess. We have this contribution from a performance all across the world. It's not like that it's only one bucket that has performed very well. This 22% comes actually from 22% from North America, combined the US and Canada, which are accounting for 50% of the entire constituency in our index. We have Europe, which is again another quarter, makes up to 75% of that index, which is up for 20%, and the remaining 25% is our region, Asia Pacific, and we have had as well a phenomenal year to date with roughly 20% in local currency. So we're doing very well, except Hong Kong, which is unfortunately so far the weakest market as we speak. But the good thing, the REITs are up 5% year to date in the index, while the developers are slightly minus as we speak. That's kind of a very rough global coverage. We're doing good within our fund selection. We're up 31% for the year.
Fantastic. So 20% across the board, except Hong Kong, which is flagging slightly. To be two REITs managers here, what's your perception of the outlook from where you're sitting?
I would say that the world is still, the world is still rate hungry. I would say that people there will still be support in terms of the towards the interest rate sensitive, because the thing is, I just counted that since I would say in the past 4 months altogether there were reported 28 interest rate cut in the world already, 28. So basically, the entire world is cutting interest rate. That means it's going to help the REIT performance, because when the interest rate cut, all these interest rate sensitive REIT as well as the bonds would be supported. So that is going to be. I don't see the trend in. I mean in terms of change in terms of the the interest rate outlook. So as a result of that, REITs should be supported.
Yeah. Okay. Fantastic. Just by way of introduction, let's go ducks in line. Could you just tell us a bit about the funds that you manage, New Century and Link?
Maybe Link first.
Yeah.
So for us, we are a hotel REIT basically. Although our mandate is can cover any asset types in the world. So our asset right now mostly in China, and then we do have a hotel in the Netherlands. So in terms of the hotel, all the hotel under operating lease. So as a result of that, in terms of cash flow, are actually secured for, let's say, 20 years. So for us, I would say that if we just look at the performance of the REIT, it's more like a bond, a fixed income product kind of nature. So from my perspective, the thing is, I used to be a fund manager as well on REIT equities, so in other firms. So for me, if we look at the REIT at that time, 3 aspects, organic growth, external growth, which is M&A, and then yield compression. So I would say that, right? So for me, I would say that organic growth, for equity investor in general, for our portfolio, because our rental income will only be indexed to CPI in Europe. So CPI in Europe, how strong it is. So as a result of that, the thing is, our growth is mostly on external growth. So we have to continue to go for M&A before we could get investor interested. That is the issue. Yield compression, I would say that we do have a little bit room for compression, but the thing is, I would say in terms of portfolio, our size is smaller, much smaller than Ling REIT, and our portfolio is not as defensive as Ling REIT. So I pass on to to Ling.
Here's a hot potato.
Okay. Yeah, well, Link REITs, I think, is a familiar name to all the investors in Hong Kong and actually in the region if you constantly buy REITs, right? We're the largest REIT in Asia by market capitalization. We're 76% in retail, 17% in car park, 7% in office. Majority of our assets in Hong Kong, 12.5% in China. So we have a portfolio of shopping centers when I refer to retail. They are mostly community shopping center in Hong Kong and regional shopping centers in China. And for office, we have our headquarters, which is a joint venture with Nanfeng in Hong Kong, Kowloon Bay, Kwun Tong area. We also have a CBD office in Shanghai. So we not strictly speaking Hong Kong REITs anymore. Our mandate also allow us to go anywhere out of Hong Kong as well. There's only asset class restriction that we set for ourselves, which is we don't invest into anything that allow people to stay over 24 hours. That is residential, service apartment, and hotel. We just basically don't know how to manage if they sleep overnight. Yeah.
Fantastic. As always, questions, welcome at any time. I know your audience has been quite quiet today, apart from an exception, Mr. Vankovic. Any questions any time, please put your hand up. Please put your hand up or throw something at me. Either way is fine.
I'm going to ask a question.
Yeah, okay.
So why do you think, I don't need that. Relative to Singapore, which has got a very robust and established REIT market, and forget about U.S. and other REIT markets, and yes, the U.S. REITs do great. Why do the Hong Kong REITs, relative, with the exception of yours, which I think is the only REIT actually trading at or above NAV in Hong Kong?
Unfortunately, at this moment, it's about 10% below. But yeah, but we have always been about or above NAV. Yeah. Yeah.
Why do relative to Singapore, why do Hong Kong REITs lag so much in terms of performance and huge discounting?
Yeah, I may take this, and then I'm very curious to hear, obviously, as well, the real case. From a buy-side point of view, I think it's kind of two different jurisdictions, not from how the REIT is set up. It's really about the background. We do have large corporates, developers as well in Singapore, but here in Hong Kong, I think many of the REITs are dedicated to their sponsors, which are in control of a family, very wealthy family, a very wealthy developer in the back. And their main background for the REIT has been a stable kind of bond vehicle, while in Singapore, we do see a little bit more activity. We do see this organic growth. We see this M&A-driven growth, SPH buying Westfield Marion last Friday as an example in Adelaide as one of the earmarked transactions for this year. While we do not see this kind of activity for the general REIT space in Hong Kong, except obviously Link. And one big problem is, as I assume as well, the discount, right? When you're just trading at this discount, it's very hard to narrow it. There are some low-hanging fruits. One is disclosure, and one is as well, obviously, being more active and trying to close this with more interaction, accessibility, and incentive schemes, for example, same boat investments with investors. And I think here the Singaporean market has been adjusting better towards general equity expectations maybe, and that helped certain names to grow faster and close that gap. The external versus internal management scheme within the REIT and the REIT trustee is maybe one of the most important schemes, and that justifies the premium on a long historical term from Link REIT.
Pretty comprehensive answer.
So
Eric?
being a small REIT in Hong Kong, I have to say that, in the past 6 years, we have been trying really hard to grow our REIT. Through organic growth is really slow, so we have to go for M&A. So if we go for M&A, then a lot of hurdles we have come across. First of all, our in terms of dividend yield, you have to be yield accretive in the first place. So the hurdle is high in the sense that the dividend yield. And on the other hand, in terms of capital raising, it's actually not easy in Hong Kong. It's more chicken and egg because the market has not been as liquid apart from Ling REIT. Then it's getting difficult for you to raise money. Without being able to raise a lot of money, then you will find it difficult to do the acquisition. So it's more chicken and egg. On the other hand, I would say that in terms of the regulators' attitude towards the product itself, although the government has been always saying that trying to develop Hong Kong as a regional REIT hub or whatever. But the thing is, it seems to me that based on the interaction with the regulator, I think they want the primary goal is not to make any mistake rather than grow the market. Let's say, for example, we acquired the Dutch hotel, which is the first Western acquisition among all the REIT, a few years ago. And our announcement was 40 pages. So just to give you just an idea, 40 pages. Around that time, there was a listed company under the supervision of Stock Exchange, acquired similar kind of things, real estate. The announcement was 4 pages. So you can tell the difference in terms of how tight we are in terms of being supervised. And also, the structure at the time when we decided, because Hong Kong doesn't have any dividend tax. And then as a result of that, for us, if we want to, let's say, for example, I want to buy, get around the difficulty in terms of raising equity through trying to issue perpetual bond, which is allowed in Singapore but not allowed in Hong Kong. The reason being, in Singapore, the regulation is if you don't distribute 90%, then you don't enjoy the dividend, the tax transparency. In Hong Kong, you must distribute 90%, no matter whether you want to get the benefit. Anyway, no benefit, no tax benefit. So the thing is, as a result of that, because of this kind of legal issue, then Hong Kong cannot issue perpetual bond. So these are the 2 examples telling you that why structurally the REIT in Hong Kong are, from my perspective, a little bit handicapped, I would say, versus the Singapore REIT. And also, on the other hand, the mentality among all the Singapore REIT in general, initially, most of the REIT spun off, at the time when the Singapore S-REIT market developed, most of the REIT was sponsored by the government. For the government, of course, they want to support them, with a lot of assets for them to acquire. And then later on, become the private market. Then, the thing is, Singapore, just like Hong Kong, domestically, there are not a lot of assets for them to buy. Their mentality is always going overseas, capital land, CDL, they always go overseas. So that their culture is to go overseas anyway. So once the REIT market is developed, they go overseas, then go for M&A. So this is the kind of, the mentality difference in terms of versus Hong Kong. Hong Kong, all the tycoon, they are so rich already, and then they don't need to be hungry to go overseas. So these are more structural, I would say, difference between Hong Kong and Singapore REIT as a start, I would say. And that is also causing today's, I would say, divergence in terms of the market development.
Comprehensive answer, I think.
Thank you.
Anything to add, Christine? Or?
I do agree size matters because we're so big and there are a lot of funds that track us and we include ourselves in a lot of indexes. We make sure our investor base is global enough that from time to time there would be investors interested in us. There's high liquidity in our shares. We just reduced our lot size to 100 units. And then also because our portfolio is big enough that there are a lot of things that we can do. We can show the world that we are a very active manager from organic growth to acquisitions to enhancement. And our return has proven that is still room for growth. For instance, in the past 5 years, our total return is low double digit. It's better than a lot of the private equity funds. So that's why we are trading better compared to our peers. I think there's a lot of growth expectation, and there are a lot of funds that's tracking us. They have to buy us. We are part of the Hang Seng Index constituent stock, so we are naturally included in the Hang Seng Index, and so we go up and down with the blue chip. That's part of the reason why we perhaps trade better than our peers. Yeah.
Yeah, which is again, in good times that works out very well, right? In bad times where we're in right now, it can as well be a lag. And despite very good results last night, stock trades down 1.6%, and that comes when you're the 7th largest REIT in the world in the global index. You're going to get influenced or impacted as well by global investors, which are just shorting Hong Kong now as we speak, and as I assume.
So you're going to double up? Or
Double up, yeah.
Fantastic.
Are you on the Shenzhen Shanghai Index?
No, we cannot. REITs cannot. We try to get it approved, but REITs cannot be part of that. Yeah.
Any more questions before we plow on? No? Great. One thing that was touched upon earlier when we got together was ESG. How big is of an aspect is sustainability now for you guys in REITs, and what are you doing to create even more sustainable vehicles?
I have to say that because we are just a passive investor. So basically, for us to do, to pursue this goal is actually not much room for us to do, because anyway, the hotel is run by the operator themselves, and the operator is independent from us. So although, we do have, look at them, in terms of, all these, to ensure that all these environmental issues are, addressed. But the thing is, for us as a passive investor, honestly, not much we can do, I would say.
There are a lot of room for us to do ESG. I think we are one of the REITs or real estate companies that have such a comprehensive ESG or a system or application or framework, I should say, framework. It's not just about energy saving, environmental friendly, but also, of course, it's related to social and governance, social. So we care about all the stakeholders, not just our shopping centers, shoppers, tenants, but also the society that we serve, the community that we are in, as well as the residents that are around us. Also, we care about our staff. So talent is part of talent recruitment, development, creating a more sustainable business model is part of our framework. Governance, we are very transparent. Well, even though Daniel said we don't pass the thickness test in terms of ESG reporting, but there's a lot of quality of contents there compared to a lot of the developers, even developers here. Yeah.
Exactly. No, I didn't want to take any position here, but it's interesting. ESG, that's the new important investment scheme. What disclosure quality was a couple of years ago. We were pounding on the table to really, especially our Asia investments, to bring this disclosure quality into the next phase. And I think, together with the help with the body industries, EPRA, APRIA, like the dedicated real estate groups, they helped us as well to put together a framework for the corporations, but as well for the investors to get a significant disclosure. And now we're stepping into this next phase where sustainability with ESG regulation is going to be a very important scheme, not only for us from the buy side or from the corporations, but especially us as money manager. Our clients, the pension funds or the insurance companies, they have very strict criteria internally how they want to have their money managed. So I have a mandate where I need to classify each of my investments from 0 to 10, with 10 the best and 0 the worst from an ESG rating. You guys, well, I'm going to give you an answer right in a minute. So. Well,
if not, I'm going to go back and speak to some people. Yeah.
All right. You can let me be there. What I want to say
Some Godfather theme music in the background, I think.
It is a very important criteria to be up there as well for getting stocks into your portfolio. If I do like a stock very much, but from an ESG criteria, I'm not allowed to put it in there. It's my job to be proactive and to seek the contact and the conversation with the responsibilities of the firm and make them fill in this questionnaire so that DJ, sustainability, puts them into consideration to be picked up in those indexes as a constituent, and that's the important one. And just the final one, so the REITs, the Hong Kong REITs, on average, they publish between 15 to 30 pages in their annual report, which is roughly 200 pages. Others, they are publishing entire ESG books. Swire Property is number 7 here. Land Securities, a UK large REIT, is number 4 in the Global DJ Sustainability Index. And it helps them, obviously, being an early mover and talking not only about the E, S, and the G, but as well going behind those numbers. And yeah, low-hanging fruit, it can help you close that discount.
I suppose other markets are far more on the pulse when it comes to ESG and environmental standards compared to Hong Kong. I mean, Hong Kong still doesn't really do glass recycling, for example. It's still lagging behind in many ways there.
Just one add-on, and this is going to be a big move. In Europe, ESG or sustainability investment has been very big for almost a decade, I would say. Next year, 2020, China needs to introduce sustainability reporting for any kind of listed firm, plus anyone who wants to issue a bond needs to fulfill ESG criteria. Japan is already doing a tremendous good job in that reporting. Every J-REIT that I meet, 60 pages of presentation, 20 is in regard of ESG. You never talk about it, but it's going to be in there once when someone wants to talk about it finally. But that's as well going to be a big driver for the years ahead of us. So I'm very positive on it.
Fantastic. We've got a couple more questions lined up, but back to the audience. If you're all still quite shy. Nope. Okay. Staying in China. So we did have one. Thank you for spotting.
I have a question on Hong Kong REITs especially. So what do you guys think about the protest activities will affect maybe in the foreseeable future, in the near 3 years, about the rental income and revenue?
Great question. Who wants to take that first?
Well, we are in the non-discretionary retail sector, so we do see some tenants in specific centers which are closer to the social activity being affected. But generally, it hasn't seen like a major impact to the extent that you see double-digit down on revenue. So, because I don't know when this will end or how it will develop, so it's difficult to predict what will happen in the next 3 years. But really depends on what sector you are in. Link, if you talk about Link in specific, then we don't see major impact yet. Yeah.
How long do you think it'll be until you see some impact? How much longer will these protests have to rumble on for?
That's a political question, not to be answered here, right?
Yes, ma'am.
Our assets are not in Hong Kong, so we are spared.
Yeah, you're spared, yeah.
You have the easiest part here, right? Now I need to answer it from an investor's point of view. Well, listen, it's not only the REIT, obviously, it's as well the developers or the so-called landlords here in Hong Kong who are all sitting in the same situation. We do see, especially in retail, rent concessions coming through. So a large portion of retailers are getting this concession, as we know, for a couple of months' time. It can be double-digit cut. The question again needs to be asked for how long this is going to be. I asked that question the CEO of Swire Properties on Monday, and he told me it's not going to have a big P&L impact. So it's really more about keeping occupancy high, attracting the footfall of your mall, and making sure that if there is a shopper who wants to come, they should be welcomed and not only have 2 shops open and 1 shop closed. And just one important point, it's not only the protesters. Hong Kong is very dependent on Chinese tourism, obviously, as well. This is not the Link story, but this is more for all those shopping centers like Harbour City, for example. In the very beginning in June, when I met with Wharf REIC, and I asked them in terms of, how is this going to impact with all this turmoil on the streets, your sales? And they're like, we're not really caring about those protests. It's the RMB that hits us very badly. First of all, we have this, Gucci and Louis Vuitton product as well, not only the fake one, we have the real one now back in China, plus the price adjustments, which has been pretty large, has been 20-25% for certain goods, even higher. Watches are still in this kind of range, but it has been diminished, so the price difference is not that big anymore. So if you want to buy that watch for your wife on a Saturday afternoon because on Sunday is the birthday, you don't need to organize this through Hong Kong anymore 2 weeks before. You just do it somewhere in a shopping center in Shanghai because your price difference is not that different anymore. And when you're going to get with your suitcase with the 10 Rolexes back to Shenzhen, now they screen you at the border and you need to pay that tax, which may have been a little bit different in the past though.
Well, you don't need to go to Shanghai. We have a shopping center in Shenzhen as well. But I mean, in terms of Shenzhen, it has been impacted by what's happening in Hong Kong because we compare the sales data, F&B and some casual retail actually has gone down, not just because generally there are more shopping centers or the immediate impact you see from the US and China trade war is we just suddenly realized there are a lot of Hong Kong young people or family do go to Shenzhen to spend over weekends, and that number has gone down. Yeah.
But to be fair, in terms of the the decline in mainland tourists, I would say that it's not just Hong Kong. I would say that in the entire Asia, they all reported this first half this year reported decline in terms of the tourists from China. I would say. And the situation in Hong Kong just make it more acute because of the event in June, starting June. So I would say that in general, it's the reduction in terms of tourists number actually a reflection of slowdown in Chinese economy anyway. Everyone can see.
Yeah. Fantastic. 4 minutes left. Any last questions for our delightful audience? Delightful panelists? No. Okay. Moving forward then. What are the game-changing trends that you're seeing impacting the REITs market over the next 12 months, or have impacted, and whose impact will be coming to fruition in the next coming months? What are the game changers?
Well, there's not going to be a brand new world. I hope that we finally going to get into a new territory where everyone can focus on its investment and its full 9 or 10 hour workday, and not only something which is going to be interrupted after a couple of hours, but from a game changer. This is the game changer for me for Hong Kong on the short run. Hopefully that we are just finding it a little bit more calm. But on the entire industry, I'm very positive on the China REIT introduction. This is something we're looking very closely at. We do have just an IPO in the making with shopping centers and offices in the Shenzhen area. This is something that we are finally seeing coming through. And then in the Philippines, we see as well a new REIT regime to come alive. And this kind of push forward for our REITs industry is a great gift that helps us as well, showing the sustainability and the importance of the entire industry.
Fantastic. Christine, Derek, do you see any sort of game-changing trends coming up that people need to be aware of?
As a REIT, not much. I would say that for us, we still continue to look for acquisition, which is the growth driver for us. So in terms of the developing the REIT market in China, that's not something that we can control. But the thing is, I do see that the thing is when we interact with a lot of the the asset owners, many of them actually want to offload the asset, recycle the capital. But the thing is because the REIT market has not been developed, so it's difficult for them to do it. So this is the first time I've ever heard of. Is it a real REIT, or they have been doing REITs types kind of securitization, but the thing is a real REIT.
But it's going to be listed in Hong Kong, so we're still not at the real C-REIT.
In terms of supply, is actually could be significant when they have a breakthrough in terms of the legal structure, to be listed in China. But I think it's at this stage, the hope it will come early. I would say, in terms of the REIT market in China.
Fantastic.
I don't know if it's like a game changer, but it's continuous trend that there's too much money chasing after assets. So everywhere we go, no matter whether the economy is looking good or looking bad, or whether the liquidity is tight or loose in those markets, there's still a lot of money chasing high quality assets. So, but I think our investors also realize that, and so long as you can demonstrate your portfolio has sustainable growth and stable dividend, I think they still appreciate your strategy instead of doing nothing, because they also have money to invest as well. They want you to grow bigger. They want you to manage actively so that they at least can arbitrage themselves. Yeah.
Okay, fantastic. You have 44 seconds.
Question just for Derek. On your acquisition
Of course, we look for asset, real estate asset. On the other hand, we also look for platform as well, owning the asset. But I think it's given the capital market, it's not difficult, it's not easy to raise equity. So nowadays, without the support from, maybe a few years ago, we were more ambitious in the sense that we could partner with the
through like a business trust, maybe, yeah.
No, the business trust even worse in terms of structure.
Well, you define your own trust limits, right? The rules you can
just
set
go
it
for a
yourself.
normal property company.
Yeah.
Which was the big.
Yeah.
Sorry to interrupt. It was a big discussion when Wharf was spinning out their assets, right? Harbor City and Times Square. Why not in a REIT? Why keep in it? And it all ended up in the payout ratio. You're forced to pay out your 90%, and these guys don't need to do it. 65 plus the lever. Nobody cares about the lever.
You should have been in the meetings with the banks. I think people like to say the word REIT. That's the only difference. I haven't figured out either. So we're going to list just as a regular property company, but incorporate REIT-like features to do a mandatory distribution of dividends in our
And the risk for development, right?
all
Yeah.
stable value-add assets.
Which gives us as investors within a REIT, the certainty that they can't turn nuts and just suddenly start 50% of developments within a corporation, while a non-REIT obviously has all the will to do so.
Fantastic. People, please put your hands together for our fabulous panelists.